I'm Veronica Morgan. This is Cate Bakos and Meighan Wells, and we are comparing the property investment landscape in Brisbane, Sydney, and Melbourne. That's the eastern seaboard of Australia. So watch this video if you want to know, what does your money buy you in each city in 2024? Which city offers the best long-term investment opportunities? What's happening with rents in each location? And I'm going to hand it over firstly to Meighan to introduce herself and why the hell we should be chatting about this stuff and sharing this intel with you.
Thank you, Veronica. I'm excited to be here actually, because this is one of the first times that I've actually been able to drive the conversation together with two other very well regarded colleagues in other states to actually say what is happening, what are we seeing, and what is real, as opposed to what you might be reading in the media. So I'm Meighan Wells. I'm the principal of Property Pursuit Advisors in Brisbane. We've been going for 20 years. We've had feet on the ground for a very long time. And what I'm hoping that I can share with you tonight is what's really happening so that you can make really well-informed decisions about which city you might want to invest in.
I love this. I'm Cate Bakos, and it's a joy to be chatting with you both. We enjoy our off-the-air conversations, and it's wonderful to put this together for the listeners and viewers. I run Cate Bakos Property down in Melbourne, and we often have investors coming to us asking which state should we be purchasing in, and they often have the questions that aren't the right ones to ask. But the reality is, I can't talk about other states. I just know my state and my hometown really well. And that's what's joyous about this, where we're getting the three of us putting our heads together and giving some, really interesting on the ground, in the trenches information.
Well, I'm Veronica Morgan. I'm the principal of Good Deeds Property Buyers here in Sydney. And we sit right in the middle of you two because we're 15 years old. Cate, you just turned 10. Meighan, obviously 20 years in the business. And in fact, we've all been in the business longer than our businesses existed, but that is how long our individual businesses have been operating. And this is the thing, in the buyer's agency space, there is so much in the way of new information, new entrants to the marketplace, and a lot of noise about the right things to do and right investment methodologies and all the rest of it. So what we thought we'd do was bring a few old heads together, if you like, tried and true heads who've been around a long time and actually have seen investments that have worked, seen investments that haven't worked, been involved with clients that have bought elsewhere, not just in our own areas. And we're all a bit agnostic. Yes, we are quite passionate about our, area that we live in and we buy in. And we firmly believe that you need to be a local specialist to buy property for clients. But the reality is, we understand that clients often need to diversify their portfolios, and we're often asked questions about where else to invest. And that's why I thought, let's get the three of us together to have this conversation. So we're going to go through one at a time and run through a variety of topics to answer those questions I mentioned earlier, which is, what does your money buy you in each city in 2024? Which city offers the best long-term investment opportunities, and what's happening with rents in each location? So I'm going to hand it over to you to start off, Cate.
Absolutely. All right, well, let's talk about it. The first one, general market conditions. Melbourne's been in the media for all the wrong reasons, unfortunately. We've had a lot of headwinds from our extensive lockdowns and rental eviction moratoriums and challenges there for landlords, all the way through to land tax and obviously we've had really static price movement. We've pretty much flatlined. Every month we're either up 0.1 or 0.2, or we're down 0.1 or 0.2. And the opportunity for buyers, I would argue, has been great, because you can really finesse your search and take your time to do your due diligence and buy at yesterday's prices. And I haven't seen Melbourne stand still like this for a long, long time. But what it does mean is we've had some speculative investment from interstate people in Melbourne, because a lot of people assume that when all of the other cities are doing well and Melbourne's sitting static, that Melbourne will have this enormous bounce back. Now, there's no doubt about it. If you look over the history charts and you track where Melbourne's been on the league ladder, positioned against other capital cities, we've had our fair share of moving up and down that league ladder. So it's not uncharted territory as much as people think it might be. But I think that there's a lot of upside for Melbourne when we get our economic conditions under control and when we get investor sentiment a little higher. But in the meantime, I can quite easily talk about what your money buys you in Melbourne, because I've had about 18 months to get used to it, because our prices haven't really done anything.
Right.
So I do comparable sales analysis, And you know
And
what?
you can go
If
back
you
12
can't,
months and it's the same.
yeah, that's it. You
Nice.
can't get a data point in the last 3 months. Go back 2 years. And that's a very unusual market to be
Mm.
navigating. But that's essentially broadly the market that we've been navigating. However, when you segment it, as in all market segmentation, Melbourne then starts to tell a little bit of a story. So we've had more price growth at the lower quartile and the even sub median, but we've had prices come off a little bit at the top quartile. So it's, markets within markets always. And I haven't even touched on regions because that's not what today's about. So Meighan, over to you. What are the general market conditions in Brizzy?
Almost the opposite of Melbourne, to be brutally honest, but that often is what happens. Sometimes when Sydney slows or Melbourne slows, Brisbane is where a lot of frenetic activity is taking place. But this has been an elongated period of frantic interstate and overseas activity, mainly driven by owner occupiers as opposed to investors, which is what we've seen in previous market cycles. So generally what we're seeing at the moment is that listing numbers aren't too bad. We're getting access to good quality properties, but the number of those properties is still far less than the number of people who are qualified and financially able to purchase those properties. So the inequity in demand and supply is still far in favour of the seller as opposed to the buyer who's struggling to find something. We have had a slowdown in interstate migration a little bit and repatriation. So a lot of those Australians who were living and working overseas who came back, that slowed down to a great degree. But what we haven't seen is the historical departure of Queenslanders or people particularly from Brisbane going to Sydney and Melbourne or going overseas for higher paying jobs and career opportunities. That has largely stopped. And that's why we're seeing such a bottleneck of people. We haven't got as much interstate and overseas migration as we had post-COVID. But the numbers of people leaving has dramatically decreased. So we've got this pressure that is building inside that's creating a lot of demand, but there's no one really selling because they haven't got anywhere to purchase. So historically, say someone who was living in maybe a house that would be worth $3-4 million, they might be moving to Sydney or Melbourne to move into an executive level job. They're not moving. So those people are not freeing up supply in that upgrade market. It's a really interesting time because what that means is the cascading effect is they're not selling their house for the person with maybe $1.5 to $2 million who wants to upgrade to a $3 million property. That person's not selling. So the person who wants to buy a property for 800 or 900,000, they can't buy that because this whole cascading effect of no one at the top end leaving means that all the way down to the entry level has had a huge increase in pressure on prices. And we've seen prices across the board increase, in particular, most recently units in the last 12 months.
Wow.
So it's a very, very buyer-driven market at the moment, and the lack of supply is increasing the prices at an increasing rate. And we've got some data to support the rate at which prices are increasing at the moment. It's a hard time to be a buyer in Brisbane.
It's funny. I keep thinking of the domino effect, but it's like the dominoes have all been super glued to the table.
Yes,
And
it
so
is like
nothing's
that because the
falling.
domino often starts at the bottom, but what's stopping at the moment is the domino at the top is not falling outside of the arena, if you like. So it's not freeing up any space.
I've been hearing stories, Meighan, you tell us if it's true, of open houses on a weekend, on a Saturday, and basically contracts signed on Saturday afternoon, done and
Yep.
dusted.
So I'll give you some examples of what our teams see on the ground. And remember, what we're sharing here is not what you're reading in the media. This is our experiences as buyers agents with our feet on the ground. So we could go to a property that might be worth somewhere around the 1.5. And there's a couple of examples that we've got where we've gone to those properties. There might be 40 or 50 groups going through the first open house. And what agents are doing is delaying any pre-first open house inspections to build that frenetic activity on the first open day. And then once that first offer comes in, the agent simply says, get all your offers in. The owners are making a decision. We've got one that's good enough to take it off the market. So they might get somewhere between 12 and 14 offers after that first open house. So it's, that old saying, it's quick or the dead. He who hesitates in Brisbane is really exposed to missing opportunities. That then sets whatever that sale price is, sets the new comparable sale price for that particular property, and it just keeps building from there. So if there was 14 offers, 13 people miss out. Those 13 people now have a heightened level of interest and desire to purchase. They all go to the next open house, plus the new people have come into the market, and it's this recycling of the same people until, it eventually someone says, that's it, I'm just going to pay whatever I have to get a property. So the numbers are, now I'm talking A grade quality in low density family oriented areas. People are a little bit more discerning with B grade and C grade properties, main roads, flood affected, they're taking a little bit longer. And anything that has had an inkling in the market that the owners might want too much, people are sitting back a little bit and waiting for the owners to come to the market in terms of pricing. But that's a bit rare because we don't really have a lot of price indication in Brisbane.
No
Meighan,
price guides.
These A-grade properties that everyone's scrambling over and, one open and then they've got an offer on the table. That takes me back to Melbourne in 2021.
Yeah.
And I look back at those disgusting conditions where we had to prep all of our due diligence prior to me seeing a property off the back of a photo in case this happened.
Yeah.
And at the time, agents were dealing with the 5-minute inspection limits and face masks and inventories and hand sanitisation, and they were so over it, and vendors were so over it. And that obviously there's only so many hours in a day that you can host these things, that the agents were happy to take an offer after one open and call it job done. But I want to ask, why do you think they're willing to do that in Brisbane when they're not dealing with the pressures and the challenges of COVID conditions?
I think that it's really hard on agents, and I look quite fairly at agents. There's a lot of really good agents. There's a lot of agents that are a little bit lazy and they go, well, I'll get the deal done. There's also a lot of owners who go through that first open house and say, I don't really want to go through that again. That was really hard work. If I can do this today and I only had to have one open house, oh yeah, I'm okay. We're not a very auction-oriented culture. So agents aren't particularly strong at building the psychological battlefield of auction, if you like. They're not good at making it go for 4 weeks and then putting everybody in competition with each other. So for some agents, it is open houses only. And if that price gets to a point that the owner is prepared to accept, then they're really probably doing a disservice if they say to the owner, well, why don't you wait? We could get more money. Well, they probably should say that. Let's be honest. They should say, let's wait and get more money. But they actually might not get more money either if they wait. And I guess that's the risk. When you've got that many people making offers and you've got a few around the high end of that, that's probably market value.
I've got a theory on this too. I think that this is something that, Meighan, I didn't add in the intro, but you and I are co-founders of Home Buyer Academy. So it's an online course for first home buyers. And one of the things that we teach is that each state and territory in this country has remarkably different legislation governing the way property is sold, purchased and sold. And one big differentiator is the vendor disclosure. And so in Melbourne and Sydney, you've got a lot of similarity. You've got both very much auction cultures, auction markets. But secondly, there's quite a high degree of vendor disclosure. And thirdly, there's the cooling off period. And so in Brisbane, when people are buying in Brisbane, they can waive their own cooling off period, whereas in Sydney, you can only you waive the cooling off period after advice. A certificate is signed by a conveyancer or a lawyer after being advised on the contract. And in Melbourne, I believe there's in an auction campaign, there's only a window, 6 days is it, that you can buy without a cooling off period? Kate?
So 3 days either side of an auction, you have no cooling off.
So you've got 6-day window of opportunity in Melbourne. Other than that, and because it's running to auction, of course, then anybody who buys before that, well, no agent is going to sell a property in an auction campaign and interrupt the campaign for a buyer to have a cooling off period. It's just not going to happen. So when you've got two very auction-oriented areas, not to say you never get a cooling off period, but you can't waive your rights to the cooling off period, which means that the agent is not going to sell to you on a Saturday afternoon because they're not going to give you a cooling off period. Whereas in Brisbane, you get less information from the owner via the vendor, so via the agent, but B, you can waive those rights to a cooling off period. Then why wouldn't you just sign up a buyer who's prepared to actually do that? And I think,
It's a
and
good point you make, and I think that's the thing that we are concerned about in the future is people finding things out that they didn't take the time to do in their due diligence in the lead up the first time they saw a house. And Cate, you hit the nail on the head. You've got to do all your due diligence before you go to that open house to be in a position to make an offer. So there's a lot to do in Queensland before you get to that point. But I think that the FOMO still exists in Queensland, and therefore people are prepared to take the risk to make an unconditional offer, which I do not recommend,
No.
unless you've done your due diligence.
Well, and here's the thing that a lot of buyers buying in Brisbane from the southern states or even from other states won't necessarily know that. You know, I know that when we started doing our research to put together our course, Meighan, I was horrified and shocked. I know when I was actually filming the show, you know, location with Bryce, when we bought up in Queensland, I left it up to him because he knew that market. Well, I had no idea. It seemed like cowboy town to me. I just could
There's a
not
lot to
believe
know.
it. Yeah, I couldn't believe it was so
We're not
easy.
all country hicks up here, but you
No,
know.
it was more the fact that you just write the agent gives you the contracts, not put together by a lawyer. It's actually put together by the RAIQ. You know, that there's hardly any information in that contract. You can just sign it, write up your conditions, and it's all very loose.
It is a different process.
Yeah,
It
it
is.
totally freaked me out.
So Veronica, tell us what's happening in Sydney.
Well, Sydney, again, like I guess my business sits in the middle of you guys in terms of its longevity, and our market sits in the middle of you guys in terms of how it's behaving at the minute. We would call this, what's happening in Sydney at the moment, to be a normal market. How very boring, right? We've had ups and downs ever since, you know, really since 2012. We had a 5-year boom, then we had 2 years down, then we started recovering, then we had COVID, then we had 2021 up, 2022 down, 2023 up, 2024 has flattened. We haven't seen conditions like this since probably around 2010. And that is really where pretty much we got modest growth every month. You got a little bit of growth, tiny bit of growth, not a lot, a bit more than Melbourne though, right? And we've got clearance rates sitting between sort of very neatly between 60 and 70% every week. And when the clearance rate sits in that sort of band between 60 and 70%, that's what we call a balanced market. And the hallmark of a balanced market is when A-grade properties are competitive, and you expect that, you know, and that's pretty much the way it is in the sort of the 10K radius of Sydney CBD that we operate in anyway. Generally, there's always buyers for an A-grade property. B-grade property, so that's your sort of slightly compromised property in a good location, but maybe it's south-facing garden, maybe it's you know, maybe it's got a slightly smaller block than normal, maybe it's a bit unrenovated, or whatever it is that, you know, lends it to being B rather than A grade. There's always a handful of buyers for those properties, and they do sell relatively quickly, with a high proportion selling within the auction campaign. C grade properties in a normal market, they really struggle. So the stuff on main roads, the stuff that's next to a service station, the stuff that's dark and dank, you know, they're the sorts of properties that buyers won't fight over because they have and choice. Now, we will talk about choice in a minute, because choice requires lots of listings for buyers to really have choice. And we have seen listings down in Sydney. Really, we've been complaining about this since 2016. So even though it's a normal market, it's balanced, it's easier for buyers to, you know, do their due diligence and have time to do their due diligence and choose, you know, and make sort of better decisions, I guess, or make clear-headed decisions. Still, when you've got a lack of quality stock, and this is what a lot of buyers say when they come into the market, they go, oh, there's not much on the market. And we're like, this is normal. It is normal to not have a lot to choose from if you're choosy, if you're picky. So that's sort of what we're seeing in Sydney at the moment, which is, I guess, you know, I don't know how long it will continue, because we've sort of in recent years been quite used to a lot more volatility, and I'm quite happy in a way that it's normal. Anyway,
it's less pressure, isn't it? And you know, we talked about agents having 14 offers on properties. Imagine having to tell those other 13 people that they missed out. It's an emotional roller coaster.
Yeah.
Well, they get blamed too, don't they? I mean,
they do. They certainly do.
I would have paid more.
Yeah, afterwards. I would have paid more. It's a nasty thing to say, really, I think, for any buyer.
You know, you get your opportunity, but sometimes people think that they're being taken for a ride too, and that's a really hard thing to.
But if you see 40 people at the door, it's pretty obvious. It's not like their property's had 200 days on market and you're the first person that's gone through it. I mean, you can see there's live competition.
Yeah, and very visible live competition. And it's very easy to see from what's been happening in an area, particularly if you've missed out a few times.
Yeah.
You have that experience of there are other people who are financially capable to buy in your price range. And we're going to talk about what you can buy in each of our cities in different price ranges shortly.
So, Kate, even though Melbourne's quite flat and not normal, but a bit depressed, shall we say, are there any particular price ranges or property types, or maybe even, pockets where you're seeing that there is more competition? And on the converse, the other side of that, is there a sweet spot for investors at the moment?
I love this question. There is a bit of competition between first home buyers for typical first home buyer stock. And, that's a hard word to use, typical, because Melbourne's had so many swings and shifts since COVID, but anything that's really well located is doing quite well at the moment. And we've had pretty good appetite and pretty good opportunity for first home buyers. And I would argue, in all of the time that I've been in this industry, which is over 21 years now, I haven't seen it this good for first home buyers. I'm not saying it's easy for them. I'm saying it's been very, very hard for them for periods over the last couple of decades. And we've got state-based and federal initiatives and incentives. And I think that that's made a big difference. And certainly in Melbourne, where prices have stood still for them. I mean, let's talk about first home buyer behaviours. They're skittish at the best of times. They take a long time to make a decision they're comfortable with. They can't make a decision on one open because they've got to bring through mum and dad and then the in-laws and then the friends. And so our conditions are really conducive to, better buying conditions for first home buyers right now. I'll freely say that. It's not highly competitive because someone who can act fast can still come in and blow it out of the water and take the keys. When we talk about the highly competitive price range of price points, though, it's the family homes that aren't super expensive. That's really hard because we know that when upgrading families are looking for their forever home, it's that they will throw all of their borrowing capacity at it to get it because they know that it's a long-term decision. They're looking at the schools, they're looking at their community, they're looking at being close to mum and dad for babysitting, whatever it is. They're the most emotive buyers that any buyer's agent will work with. And they're the ones that will push their borrowing capacity to the very edge. Now, we've also seen that borrowing capacity drop because we've had interest rate increases and we've got the buffer rates still in place. And so they know that they can afford it. It's just that the bank is saying this is where we'll loan to you and this is where your limit stops. And so they're very, very deliberately fueled and trying hard to get those properties. And when it's an A-grade property, there's not a lot out there. So our listing volumes have been pretty good. Melbourne's actually had better listing volumes in recent times than we've had in many, many years. The problem with our listing volumes is that it's a lot of investors who are offloading properties that they're struggling with the compliance costs to hold. And when an investor's struggling with compliance related stuff, it means the property probably hasn't been well maintained or it's old or it's needing a lot of compliance. And so that's not first home buyer stock. And it's not really mum and dad stock at the moment because they don't want to do any renovations. I mean, every single owner-occupier client I've got right now starts the conversation with, I don't want to do any work.
Yeah.
All right.
And it's tough. Well, we've got a builder shortage. We've got materials that are expensive. Melbourne is just a sea of trucks and cranes and everything is happening in the city in terms of civil works. And with that, we've taken a lot of builders out of the private trade. So yeah, it's been a very difficult market to navigate, but the higher priced properties have struggled here, and all of those coastal properties that people ran and bought, we're seeing a lot of expensive properties on the coast and more than 2 hours away being sold because bosses are calling people back. And of course, Melbourne was in lockdown for so long. I think a lot of people thought that their working world would change for good and that work from home would be permanent.
Yeah.
And that's understandable because it's still a lot of, we all talk about our hybrid arrangement down here. Some people are doing 1 day in the office, I'm doing 2. Not very many people are doing 5 days, but it's slowly coming back. And I think that's probably the biggest amount of shell shock that we've had. And it's definitely translated into what's selling and also what's for sale that's not selling.
It's fascinating though, isn't it? Because one thing that we talked about probably before we started recording was that so many property decisions are made with short-term drivers, short-term impetus, short-term, often a knee-jerk reaction. I thought that during COVID, when this is massive exodus from the cities, and buying second homes and it was sort of said, not a few times, but quite often, oh, well, we can't go on our skiing holiday this year, so I'll just buy a beach house.
Buy another property
I mean,
or upgrade. Yeah.
clearly this is not the average Joe that was doing this, but I often wondered at the time, I thought, who are these people with that much disposable cash, that much borrowing capacity, that much income, who can be so cavalier about buying property, given that we really don't know how long this is going to last for? And I think too, one of the things that we'll get to as we're sort of continuing this conversation is that, when people say, well, where should I be buying next? Often they're thinking with a short-term the short-term thing. It's like, where's the next place to go off? Well, Brisbane's already going off, and then people are still piling into it because they feel like they don't want to be the last person on the train. It's actually the opportunity really is probably in Melbourne right now, but you still got to be thinking, is that long-term? You do have those long-term opportunities, which I would like to think yes, right? So, and this is our conversation here, is to get people thinking with a longer lens. And so I think that's fascinating. The other thing, the sweet spot for investors, are you suggesting maybe, Cate, and maybe I'm putting words in your mouth, the investors that are selling out because there's been a lot of fairly investor unfriendly legislation and changes and taxes and whatever going on down and out in Mexico. So are the properties that are being sold that haven't, that aren't compliant, that people have not invested in, for someone who is prepared to roll their sleeves up, or is a tradie themselves, or perhaps has the wherewithal and the appetite for it, is that a sweet spot for opportunity in terms of people buying assets that would otherwise they'd be paying more for, but actually fundamentally are good? They just need to do a bit of work to them.
Yes, I've gone on the record and said many times that the buying opportunity for an A-grade location, A-grade orientation, A-grade block, A-grade street, but house that needs a massive makeover or a knockdown, the opportunity is huge. The problem is you need to be able to land bank it or deal with living in it while it's hideous. And if anyone can handle the ugly duckling for 3 years and just sit tight, save your money, wait for the builder shortage to ease a little bit, that's an amazing opportunity, because I've actually supported people who have been in that position, and we've been able to just cherry pick beautiful locations and great blocks, but they need to sit through it. And it's not as easy pitching that to a developer or a builder or a long-term investor who wants to get an architect on board. It's not easy to say to them, let's land bank it and get you a tenant, because it doesn't pass the compliance testing and it costs a lot to just dolly it up to get it to a point where you won't have a property manager, or worse still, a tribunal on your back. And nobody wants to buy a property and spend $100,000 on it before they run a bulldozer through it.
Yeah.
So that is the challenge. And the other investors down here that are selling, because you're right, we've got a lot of investors selling, and agents are all saying the vast majority of their listings right now are investors letting things go. There are the investors that don't like the holding costs and they're disenfranchised with the performance of their apartments or their townhouses. It's been an interesting market. We haven't had the same level of apartment performance as you have in Sydney, longer term, Veronica, or as you have, Meighan, short term. Our apartments at the moment are probably doing better than they have done in a long, long time, because we've got first home buyers coming back in and people looking at the opportunity in the city. And we've also got second dwelling buyers targeting apartments that are closer to town. So, for example, people that live on the coast or have their beautiful home in the Macedon Ranges saying, well, if the boss wants me back, I'll just buy a one better. There are still some people that can afford two dwellings. Very, very interesting market. And we've seen a lot of tables turn. But yeah, back to the original question, a beautiful but really dated and daggy property with the great orientation, great street, great location. They're the ones that I think are amazing opportunities.
Good bones. Yeah. Oh, how interesting. Would it be fair to say, Cate, just reading into that a little bit, that with the legislation around minimum habitable housing standards in Queensland. I think you called it something slightly different in Victoria. Would it be easier to make an apartment comply with those standards than it would be a house? Is that attracting investors
Yes.
more to the apartment market?
Not so much. Our apartments haven't performed very well. And I'm generalizing here because there are some areas that have done really well. I walked through a little one this morning in Brunswick East, and the agent said, "Oh, we had an offer of 620 and the vendor was about to sign it, and then the buyer changed their mind, but they definitely would have bought it for that." And I thought, okay, he's giving me that hint and it's going to auction. So that's clearly where the expectation is.
Mm.
I remember when I was buying those apartments in the threes, been around too long, but they have performed, but a lot of people overpaid in the leafy eastern suburbs, back in the day. And unfortunately, I remember auctions where you'd see 3 or 4 advocates fighting each other. That's not a great sign. And you don't want to be too dominant in a already investor-centric market because as you know, the prices can be quite artificial when that's the case. But I think a lot of people hung their hat on Melbourne apartments 15 years ago, and for a long time they did nothing. And investors were okay to sit back if interest rates were low, but when they're high, they're just looking at their ledger going, "I'm out of this."
So what about you, Meighan? Is everything competitive at Brisbane at the
The
moment?
median house price up here is about 920,000, which is up almost 17% in the 12 months to May 2024. There are some houses, particularly family-oriented, completed, very nicely done, Cate. All the everything done really well, and just move in, unpack your bags, and enjoy your life. Those have had something in the vicinity of 57 to 60% growth since the end of 2022.
Woo,
2022.
that's, yep.
Because they're so hard to get a hold of, and very similar to Melbourne, there is a shortage of trades and largely moving into state-based projects. So we've got a lot of Olympic infrastructure happening, and there are some very favourable payment opportunities for trades to work for state government projects. So there is a shortage of trades available to do just resi houses, whether it's building or renovation. So houses are across the board, and we're going to break down the price ranges shortly, but across the board, without doubt, the most competitive are the family homes in low density areas that are well done, move-in ready, and really have nothing to do. We also have had the surprise of the unit market, which I think they had to take off. Units have been sitting around, 2-bedroom units have been sitting around 450, 475,000 for maybe 10 or 15 years. And there was a period of oversupply. That oversupply has been greatly soaked up by people saying, well, if I can't buy a house, I'll live in a unit, and no further construction. So after we went through our oversupply and a few developers pulled their projects and said, well, I can't get my pre-sales, I won't do the development, they now can't make the feasibility of the project work. So they're now, even though the resale values are there, they can't actually make the feasibility from the development point of view work. So we haven't got any new supply coming on. So units have gone up about 16% in the 12 months to May 2024. And that is the biggest period of growth that we have seen since, look, I couldn't even tell you what the historical data is, but that has been, I think, the biggest surprise is you now can't buy a unit for less than, say, $550 for a 2-bedroom unit in Brisbane, whereas you used to pay $450, $425 for the same unit less than 12 months ago. So that market, I think, and there's a lot of reasons for that, a lot of first-time buyer activity. Units generally have a greater yield for investors and lower, and that perception of lower maintenance. So that probably is one of the most competitive and surprising markets for us. But unless it's really heavily, a huge amount of objections, as you mentioned, next to a service station or flood that you just can't mitigate against, unless there's something really overbearingly bad about a property, most properties are having multiple offers on them at the moment. And we keep a track and look at the index of price changes on properties across the board in different locations, different property types. And we look at what a property sold for based on, or what it should be worth based on comparable data. So the sales data, which is usually about 3 months old, where we think it should sell and what it actually sells for. And the differential between the data and the sale price at the moment is sitting up around 6%. So that's properties that are 3 months old, the sales data, and what the new property sells for. The difference is about 6% in 3 months, generally across the board. That's pretty rapid growth.
Yeah.
Yeah.
Yeah, it's too rapid. I'm getting flashbacks to 2021.
Yeah.
I remember being so entirely
So we've
stressed
been
out
like
by
that since 2021. This started in October 2020. This pressure on prices. It's been going consistently since then without abating. It's remarkably hard. So they're probably our competitive price ranges are everything.
Yeah.
You just can't really buy unless there's oversupply. You go into those outer areas where there's still house and land packages to be released, and they're not having upward pressure on prices.
Interesting. And I guess a little bit what we're talking about is a little bit biased towards the inner rings. Certainly for me, are you too, Cate? You sort of more thinking inner rings when you're talking rather than the outer suburbs?
Not necessarily. I'll go for middle ring if they're gentrifying, and that's driven by price.
Yep.
Nobody comes to me and says, "I want a gentrifying area and I've got X dollars." They are trying to do something in the metro as close to the CBD as they can get with the money that they've got when they're chasing capital growth. And so that doesn't mean that they won't get performance. They will. It just might be a bumpier ride because we're talking about, like anything, an ugly duckling area. You've got more challenging tenants. And so you've got to be prepared for those conditions. You're not necessarily talking about, a couple of medicos or, a couple of lawyers. It's not the same.
And also gentrification actually takes years. I mean, we look at Marrickville as in a West Sydney suburb now. It's really quite diverse. It's a very large geographically. It's very diverse in terms of its stock. You've got little workers' cottages right up to 4-bedroom homes. You've got apartments. You've got industrial still. You've got some converter warehouses. You've got sort of gin distilleries sitting amongst bakeries, sitting amongst coffee roasters. But it's really vibrant. But 20 or even 15 years ago, people would come to us, at the beginning of Good Deeds, they'd come to us and say, "Oh, look, if I have to, I'll live in Marrickville," And we really only started seeing that shift probably be about, say, 8 or 10 years ago, and so people
So
are
you might have
making.
started that. You might have actually driven that gentrification process yourself, Veronica, putting your clients in there because you knew what was coming.
Supposedly, John McGrath did when he quoted that it was the Paddington of the inner west, which is, but anyway, so that you can almost, it's correlation or causation, not quite sure.
So tell us what's happening in Sydney, Veronica. What are the most competitive price ranges and property types that you're seeing?
Look, certainly in that sort of, we focus on the 10K radius, but like you, Cate, we'll push out to sort of 15, maybe 20 if necessary. And 4-bedroom family homes are really in demand. And particularly because in those inner areas, the block sizes are smaller, it's actually quite difficult to get a well-balanced 4-bedroom home where you've got, 2 living areas and 2 bathrooms and enough outdoor space as well that balances it, plus parking, right? So if you have anything like that, they are just so rare that people will fight over them. So they, if they're well located, particularly with a good aspect, and even if they're a period home, it's been renovated with a modern extension out the back, then bang, 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 really fantastic, right? So at the other end of the scale, sub $1 million is red hot. Now that is first home buyer territory, a little 3-story red brick walk-up units, that type of property. And they, a lot of them are great sturdy little buildings as well. Some are not so sturdy. Some have been owned by predominantly investors for many years who have not invested in these buildings, and they are actually getting to an age where there's a lot of work being done on these buildings, right? So that said, a lot of first home buyers are unaware of all of that, and they are fighting very hard over properties that are under that $1 million threshold. And in New South Wales, you get free stamp duty up to a purchase price of $800K, and then you get concessions, or it sort of fades out up to $1 million. And even though it's like they butt right up against $1 million, even though they actually don't get a stamp duty concession at $1 million, it's sort of funny how they got this sort of set price in their heads. But it does mean you get a bit more bang for your buck if you do push over that $1 million threshold. And of course, in Sydney, investors generally buy apartments because of the high cost of houses. And you can get often a better yield on apartments. And if you're very careful, you can also get solid capital growth on apartments. It doesn't mean that you have to sacrifice capital growth. So that's all about location. It's also about the type of building, but also it's about the apartment within a building, as you both know, right? And obviously we avoid high-rise buildings and areas where there's a lot of homogenous stock, because we do have areas of oversupply. Absolutely, we do in Sydney. And we do buy in specific suburbs where really lifestyle is driving the desire to live there, because that will appeal to both owner occupiers and tenants. So that's all been happening. It's the two ends of the spectrum, if you like. It's the larger family home and the first home buyer territory that are busy in Sydney.
I'm fascinated by that first one, Veronica, and not that Melbourne's flying, but if there's one category of dwelling types that is doing okay, it's the 4 and 5 bedroom properties in the inner 10K radius. And then no surprises there. Your price points are dictated by your income levels, and your income levels usually suggest that they're white collar workers who have desk jobs. Many of them would, and they need to study. They need to work from home. So all of a sudden, your 2-bedroom buyers turn to 3 beds, and your 3-bedroom buyers turn to 4 beds. And every family that comes to me, they grit their teeth and say, "Oh, we'd really love 5 bedrooms." And I just think, this is really hard, because we're talking about turn of the century. I mean, I'm in the inner west, so we didn't have mansions back in 1900.
No.
They were workers' cottages. And so you've got these elaborately extended and renovated single fronts with, awesome upstairs parents' retreats. And it's very hard to find one of those. And when you do, the person who, did it, they want to get 25 years out of it. Your tenure's not 7 years. So
That's
they're
the
so
point.
rare.
And then it's an old renovation when they sell.
Yeah.
That's what we sort of find here, is that once they're finished with the family size home, it's a very old renovation that needs to be re-renovated. And that's not as attractive to people who want move-in ready.
I think that's the thing that I talk to our clients about when they are looking at renovating and extending their home rather than, upgrading and buying another one, is that get an architect involved if you got the budget to do it, and you got that size of home in a good area, and you got the income. So all these caveats I'll say here, but get an architect involved and really look at a timeless design that where, yes, the finishes will need to be upgraded at some future point, but if your floor plan and the functionality and the light and the airflow and all that sort of stuff and the room flow is done, then that's an extremely good investment, because we do that. We look for bones, as I know you both do as well. And when you see a property that, even if it's a 20-year-old renovation, it's got all that space and you think, this is well done at the time, it just needs a cosmetic revamp. Oh my God, aren't they wonderful? Love them.
So true. So true. Now, I know this is probably where a lot of people have stayed with us to find out what you can buy for different amounts of money in our 3 capital city locations.
Yep.
Cate, kick us off.
All right, let's talk about $600,000 to $700,000. This is either first home buyer territory, because our concession for stamp duty finishes at $750, but below $600 it's free. So we've got a sliding scale between $600 and $750. So we do have a few first home buyers here, but we've got, if anyone is going to invest in Melbourne, and that sounds awful because I see the opportunity, but if we've got interstate investors, a lot of Sydney and Brisbane people look at Melbourne now and they do think we're Mexico, particularly with the median house price data out. We've lost our place on the league ladder there, and they're looking for something, and they almost always want a house. They don't want to buy an apartment or a townhouse. And so I start talking about Geelong or Ballarat, and they say, no, we want Melbourne. So between 600 and 700, you do have to make some concessions, because you're dealing with lower socioeconomic areas. And I can select some that I feel very confident will deliver growth over the long term because of a variety of things, whether it be some great projects, and it might be the train connection to our airport. It could be other infrastructure projects. It could be the really big hospitals where a lot of investment's going in and a lot of professionals are working in those areas. We do have a few to choose from, but they're not in the inner ring and they're not blue chip. So 600 to 700, you can buy a house in Melbourne, and in the west, it would be probably around that 17 to 25 kilometre out. Interestingly, in the north, if you can get to 750, you can buy something in that 16 to 17 kilometre distance. And I've talked and blogged about some of the suburbs around the Northern Hospital, so the likes of Thomastown and Laylaw, which are just above the Ring Road. And we've seen an enormous amount of popular housing activity stretching up from Northcote, Thornbury, Preston, Reservoir. Anyone who's Melbourne based will know what I'm talking about. They're all on the one train line. Once you get to the top of Reservoir, you've got to kind of cross that difficult barrier, which is the Ring Road, and that takes you into Thomastown and then Laylaw. So these are old areas that, similar to the areas that I'm talking about in the western suburbs as well. You've got brick and tile, triple fronted homes on anything from 500 to 800 square meters of land. So for a lot of people who are looking at long-term investment capital growth potential, they're eyeing up all of those things. Could they subdivide? I get all of these questions all the time. I personally think going for something that's not necessarily subdividable in an area that's not subdividable will give you peace of mind that your streetscape will stay nice and family friendly and pretty. But yeah, that's my little list for the 600 to 700 price point. And I'll throw that over to you, Meighan. What can you get for 600 to 700 in Brisbane?
A lot less than 12 months ago. And that's the interestingly, first time buy stamp duty concessions changed on the 9th of June in Queensland, and first time buyers now are fully concessional, so zero stamp duty up to $709,999, which is quite an increase on what it was, which has opened up a little bit more for first home buyers. And as we all have said, first home buyers often compete with investors with a similar sort of budget. So fully concessional up to 710,000, and then a sliding scale of concessions to 800,000, which is much more in line with first home buyers style properties. Now, we're not just focused on first time buyers here, although Veronica and I can sometimes slip into that space when we're talking to each other in this. But in that 600 to 700,000, you're really looking at a 2-bedroom unit, 2-bed, 2-bath, 1-car unit, or a house that is out. There are select locations in the Western Corridor that will buy in just specific property types in specific locations. There's a lot of risk in that Western Corridor because there's old mine shafts in certain suburbs. There's black soil that's really reactive that makes slabs actually really unstable.
Wow.
So there's structural issues in some locations. There's a lot of land still to be released in some locations in that Western Corridor. And I'm talking out to Ipswich. So it's an area that you have to be extraordinarily well across and have great local knowledge. I personally don't have that local knowledge, but I have a valuer on staff who has been in that area for 20 years and he knows it like the back of his hand. So that's really where you're going to find a house with some infrastructure projects and some gentrification that are happening that would be positive for those locations, or a unit, probably not a house. Now, interesting, we're going to talk about the next price range shortly, but that changed really, really rapidly. You used to be able to buy a house at around the 12 to 15 kilometre radius from the CBD up until about 12 to 15 months ago. So it changed very rapidly.
It's actually interesting, before I hit you with what you get in Sydney for that money, which you can probably all guess what the answer is. But when we have investors come and talk to us and say, oh, what can I get in Sydney? And usually I say, don't invest in Sydney at that budget. In fact, that ship has sailed, that horse has bolted. $600,000 to $700,000 in Sydney is not going to buy you an A-grade property. It's just not. And so I've always directed people to go, and until recently, we would have said, oh, look, perhaps you should definitely talk to Meighan in Brisbane, her team in Brisbane, maybe talk in Adelaide for argument's sake, right? But since Melbourne has been in the doldrums, it's like all of a sudden Melbourne, Adelaide and Brisbane are all in the same, they're in cohorts. You guys are in the same cohort. and I will just knock Adelaide out, and I know that people will argue with me that Adelaide's a great place to invest, and I'm not saying it isn't, but I think that when you got to look at the Eastern Seaboard and the population that we have on the Eastern Seaboard and the drivers that go into an investment market, if you've got the opportunity to talk and look and compare Melbourne and Brisbane, I would. I wouldn't be looking further away into our smaller cities. So 600 to 700,000, pretty much, I would say, look elsewhere. And I'm going to just take over 700 to 800,000. That's our next bracket, and say the same thing for Sydney. So over to you, Cate.
Okay, so the next bracket, if I'm dealing with a first home buyer or an upgrader, and they're wanting something closer into town, you can get a particularly nice, villa unit or a smaller townhouse or a really great apartment if you're in the east for this kind of budget, and you do see a bit of that. To be looking at houses though for upgraders, for families, it's not really a commonplace budget. It's a difficult one unless you're going into those areas that I was speaking about before, but they've tended to attract more investor interest because of the potential longer term for growth through infrastructure projects. And let's talk about upgraders. They really want good schools and community around them, and often they want to be close to parents. So this isn't really the price point where I'm looking at family homes. I'm either working with first home buyers or someone wanting to be close into the city, and you can get quite close into the city. In fact, with this budget, you could get a good quality city apartment if there is such a thing. I'm being a little bit facetious because if you've already geared yourself up for high rise and you know what you're looking for, you're aware of cladding issues, you're aware of special levies, you've got a willingness to deal with high outgoings, because your OC fees, they'll always be higher because there's lifts at a bare minimum. But when you've got gyms and pools and concierge, that's when your OC fees go through the roof. But if you've got a preparedness to deal with $5,000 a year in OC fees, and you're very selective, you can get a great 2-bedroom apartment for 700 to 800, very close to the city or in it. So that's certainly where we've been a little bit active with the inner city buyers as well.
Right. So a house in Brisbane, and again, I don't want to keep saying this to make people feel, oh, I missed the boat, but just to give an indication of the rapid changes. And if anyone is thinking about doing something, not to delay the actual action if they're in a position to do something. But one of my staff bought his first home in, I think it was late last year, paid 690,000 for it in Capera, which is in that kind of middle ring on the train line, just a good solid post-war house on about 700 square meters. So about 690 was what he paid for it. You can't buy that house now for less than 900,000. In fact, it's now into the mid nines for the same house. And I say the same house because they are the same house. They're all in that area is the same house, 3-bed, 1 bath on a similar size block of land, made of the same materials with the same sort of layout, which is practical, good bones. And that's how much things have changed. In the $700,000 to $800,000 range, we're now looking at largely townhouses. What I like about townhouses in Brisbane is that they're not really making any more of them. So if you can get your hands, as an investor or a first-time buyer, if you can get your hands on a 3-bed, 2-bath, 1-car townhouse in a low-density, family-oriented suburb, they're not going to make them anymore. So there's a scarcity factor to them. They used to be a main sort of construction staple of developers, but a number of years ago with some rezoning, the same block of land can be either developed into townhouses or a 3-level block of units in Brisbane. So a developer will actually get more yield out of doing a block of units than they will out of a set of townhouses. So they don't do the townhouses anymore because they don't get the same sort of profit return. So that's where we are absolutely putting people with that $800,000 price range into townhouses, and they have been performing quite well, and the yield sits at about 5.1%. Body corporates, so you say OC, Veronica, your strata levies, body corporate levies are usually somewhere around the sort of $3,500 to $4,000 because there's not many facilities there.
Yeah,
don't have pools, don't have lifts, just your average upkeep.
Driveways,
Best kind,
garage doors,
gardening, great investments.
Yeah. And then look,
highly sought after.
Yeah. And you get, in townhouses in Sydney, for example, a great stopgap between a house and an apartment. So if you can't actually afford a house in a good suburb and there's townhouses there, you get a bit of grass, you get a bit, it's a great
courtyard.
middle of the road, I guess, property. Okay, well, I'll kick into 800 to 1.1 million. That's our next price bracket. And in Sydney, I can actually say something now. But it is slim pickings, right? So if we're talking about the inner rings, we're talking older style apartments in places like Ashfield, which is sort of, in the inner west on the edge of it, if you like. I mean, in the sort of northwest, we're going to Gladesville, somewhere like that. The eastern suburbs, you can pretty much forget about it if you're looking at A-grade property. Not impossible, but it's extremely difficult, and I wouldn't be loving the apartments in this price bracket in the east. And the north, as I said, we're talking Gladesville, which is sort of northwest, really. There is the Sydney Metro new rail line is going in and is about to be open literally days after we're filming this. And that actually will extend and make access to the city for people in the northwest a lot better than it has been. They've been relying on this thing called, I think it's called the busway. Not that I go out there very often and we don't buy out there, let me tell you. But there's a busway that's been running along a motorway for, I don't know, decades now. And this new train line, or this new metro line, is going to connect those people that previously would have been in bumper to bumper traffic for a long time or dealing with bus only access to the city. Via a train line, they can probably get to the city in, say, 40 minutes from places like Kellyville, Castle Hill. So that is going to change and give some opportunities for investors who want to buy out that way. It's massive family home territory. So you're sort of buying big family homes or family homes. There's older parts of these suburbs and the newer parts. But there's also, a fair amount of apartments that have been built along that rail corridor in previous years, shall we say. So out there, you're going to see opportunities. I can't talk to them because we don't buy out there for our clients, but that's certainly an area that has had probably going to potentially the price increases that come from that new infrastructure probably already baked into the prices. So be very careful about that. But that's certainly a change in terms of accessibility to the city. And then what we do see in those older style units, though, is, they tend to be those 3-story red brick walk-ups. And they can be in, say, in a suburb like Ashfield, for example, where there's a lot of them. You do have to be careful that you pick the right pocket of the suburb and the right buildings, again, within that suburb. So there's a lot of overinvestment in years gone by. As I mentioned earlier, a lot of buildings that have been heavily owned by retirees and investors who typically have wanted to keep their strata levies really low and not invest a lot in the overall upkeep of these buildings. So you do have to be quite careful. But, well-located apartments in well-maintained blocks can be really good. Over to you, Cate. 800 to 1.1 million.
I'm still rocking in the corner about your comment about apartments in this price point. I like this price point, especially when I get the challenge of finding a house in the inner 10K radius, because it can be done.
Wow.
It will be little. If it's not little, it's not A grade. I know that's a snobby thing to say, but up to 1.1, I can get a great street and a great location and a really pretty facade, but it's going to be very little. It will be a 2-bedroom, single-fronted, period Victorian, and it won't have a lot of outdoor space, but it'll be great. And if you can find the tenant that's happy there, it's a single or a couple that get along, that's your market. And right now, every tenant is out. Melbourne's rental market is, well, it's not healthy, especially if you're a renter, but if you're a landlord, you've got really strong demand and you won't be vacant, even if it's a really tight little place. So I do love that challenge when someone says, I really want to be in the inner 10K radius and this is my budget. But otherwise, it gets you a good inner ring, a townhouse. And, there are plenty in this. You could obviously go to 1.5 for a townhouse if you wanted to, but between 800 and 1.1, particularly the inner north, inner west, and a little bit in the middle ring east, you'll get townhouses in this price point. And I do get a lot of investors that are wanting to get a house coming to me with this kind of budget. So it's often the investors that I'm getting the single front Victorians for. But you will really struggle to get a family home for this kind of budget. I've occasionally got lucky with a very small home, but I wouldn't call it a family home. It might be a 3-bedder, but you'd be looking at someone inhabiting it with one child, not with two or three. And in the inner west, so I'll name some places, Kingsville, Newport, they sometimes have these little gems that are well located, and period house, 3 bedder, double fronted for that kind of price point.
Pretty.
Brisbane is probably I'm going to extend the range slightly, even though they were ranges that I suggested, probably up to about 1.2 is where I would say 800 to 1.2 here is where you're starting to get into a small house on a reasonable block in about that 12-kilometre radius from the CBD. So generally with a good set of bones, practical layout, not flood affected, not on a main road, not adjoining the railway line, but within walking distance. This is where you're starting to get, and it's very close to our investor sweet spot, which is about 1.2 is really where we're buying really quality investment properties at the moment. Generally, anything in this price range is going to need work. So it's going to be your fixer-upper, your renovator's delight, you bring your toolkit kind of property, if it's within that 12 to 15K radius of the CBD. A little bit further out, so around that sort of 20K radius from the CBD, there are some opportunities. But one of the things that's really driving prices that aren't connected to their vicinity or their proximity to the CBD is school catchment zones. So we're seeing in this over 1 million price range, a lot of areas that would not have any other reasons to be high in price other than people wanting to get their children into public schools that are performing exceptionally well in the schooling system. So people who are wanting to get into those school catchments to avoid the private school fees, but to get the education they want. And there's particular areas around McGregor State School, which is highly sought after, where prices have gone beyond what would be even astronomical price growth for any area, and they're not fundamentally the types of prices that properties that people usually buy in Brisbane. They're not the timber tin Queenslander houses. They're generally brick and tile, more Sydney, Melbourne type properties that people are going for. So proximity to the CBD isn't really the only driver for those types of things. What I think is really interesting is if the principal of that school changes, and it will at some point in time, and the popularity or the attractiveness of that school changes, will that have an effect on housing prices? I think possibly yes. So there's an X factor there in this price range, and even a little bit above this price range, which is, I think, a little bit risky because it's not based on the fundamentals of properties.
It is interesting, isn't it?
Yeah.
There's the upper North Shore of Sydney is very much driven by schools,
Mm.
and there's a lot of private schools up there, but there's also selective public schools, et cetera, and yeah, there's very much this idea that people will sacrifice. If they've only got one child, they're sacrificing 6 years of their life for the kids' high school career. But of course, if you've got more than one kid, how long are you going to basically unplug your life so you can live in a place purely because of schools? And it's quite a common thing, though, and I don't get it, but it does drive certain markets and absolutely does drive the upper North Shore of Sydney. Okay, so the next price bracket is 1.1 to 1.5. Certainly that does open up things in Sydney. We struggle when investors come to us and say, yes, we definitely want to buy in Sydney, but no, we don't have over $1 million. All right. So when we get over $1 million in Sydney, so say we're looking at $1 to $2 million, well, that really does open up opportunities for investors. At the lower end of that, we are looking at apartments, and depending on, typically for investors, we do favor south of the bridge, the bridge, capital B. And in fact, in Sydney is definitely a city governed by bridges, right?
Mm-hmm.
So people don't like to go over bridges. So the Harbour Bridge is what I'm talking about there. And the eastern suburbs and the inner west, they do offer great opportunities in terms of well-positioned and well-selected, shall we say, apartments in the lower ones, right? So that 1.1 to 1.5. And when you go over that, more options will open up in the eastern suburbs. And we like the inner suburbs such as, Surrey Hills and Potts Point and places like that, because it's really driven by lifestyle, and people with high incomes want to live there and they will pay good rents. So, they are areas that do very well for our investor clients. Also driven by owner occupiers. You've got people that are very happy to buy there, to live there as well. So it's not pure investor-driven markets. These are just highly desirable, aspirational markets.
Mm.
And so we do love that. There's parts of the inner west that do equally well, but they are more affordable. They're just less expensive than the eastern suburbs. The lower North Shore, it just has, depending on which suburb, I mean, closer to the harbour, we favour those areas as well. So, and obviously, if you can buy a 3-bedroom apartment, they are really scarce. So we do like to look for those as well, as opposed to just your 2-bedders. You're also, when you get close to $2 million, you're actually starting to think maybe we could get a little house, a little bit like Kate's talking about the inner suburbs, the little cottages, the single fronted cottages. They might be brick, they might be weatherboard. They will be on small blocks of land. They often can be renovated. So if they've been, 2 bedrooms at the front, a bathroom in the middle, opened up at the back, not always with parking, sometimes with parking. It doesn't have to have parking depending on where it's located. So well located, period cottages, they are always in demand. There's always somebody wanting to rent one, always somebody wanting to buy one to live in it. So for us, we love to look at that type of property if somebody does have the budget to be able to push up closer to 2. Although, to be quite frank, that is now for good properties that have been renovated, that are well located. You're now starting to see them in some suburbs definitely pushing over the 2 mark. So it's quite bizarre. You think it's basically double the price it is for the equivalent property in Melbourne. It didn't used to be, the gap didn't used to be that big, which lends me to think maybe that opportunity in Melbourne is really that type of property, perhaps.
Well, you said it. I cannot believe it. I can't fathom that. To spend $2 million on a single fronted Victorian terrace or freestanding down here, it'd have 4 bedrooms and an upstairs retreat. It would be that amazing renovation I was talking about.
But what we have to be careful here is what we like to talk about is what does your money buy you? But what we are talking about is focusing on always A-grade investments. You don't turn around and go, oh, that means that I should be buying two in Melbourne where I could just buy 1 in Sydney. For some people, the right decision is to put more into one property in Sydney. For others, they don't have that budget, so they should be looking at buying, in either Brisbane or Melbourne and spending less money and buying a really cracker asset. It's really about the best possible asset you can buy regardless of where it is. And I will always encourage people to look in other states rather than try to buy in Sydney, because conversely, a lot of people look at Sydney and say, oh, it's the most expensive. It's had its day. That's it. All the growth is gone. And there'll be other people that look at Sydney and say, well, look at Sydney. It's so strong. It's never going to go backwards. There's been times when it has. So it's always about choosing with that long-term view, but also understanding that things can go wrong. And really the best
defense can be a rocky ride.
Yeah. The best defense is a good asset though, right?
Yeah. Yeah. So Kate, you were just going down the path of saying what in that 1 to 2 mil range, what are you seeing?
This is my
and what
sweet
can people
spot.
look at?
There are some buyers agents down here in Melbourne whose sweet spot would be above 3. They might be, Brighton based or South Yarra based or some, dealing with the premium end of the market. But when you're dealing with mum and dad investors, upgraders, family home buyers, this is definitely a sweet spot for me. I'd say 1.2 to 2.5 is actually that home sweet spot, but a lot happens in the sub $2 million range here, and all sides of the city as well. I've had some fantastic acquisitions in the eastern suburbs in this price point too. Often in that 1 to 1.5, I'm dealing with maybe sophisticated first home buyers who have planned for their family home. They haven't done the apartment thing or the stepping stone. They've had an arrangement that's worked for them. They've probably been in professional roles. They've been able to afford the rent. They've got a great relationship together and they've decided, right, now's the time. So they've both got savings, they've pooled it, and they're buying their future family home. And it might be a stepping stone family home, but at the time that they're spending 1.5 on it, they're pretty committed to getting quite a few years out of it. And I always say to people, if your tenure in mind is less than 5 years, I don't want to touch it. And if it's less than 5 years, I don't want to touch it. Less than 10 years, we need to talk about this, because I do like to future-proof. When you factor in stamp duty and selling fees and all of the other costs that go with selling and buying, and the risk that you take when you're dealing with either being homeless or having an Airbnb or getting bridging finance, get it right the first time. If you're buying a home for your family, I want to see you talking about 10 years plus. So this is the price point range where those conversations take place for me. And occasionally I'll have an investor that's happy to spend over 1.5 and get a cracker, as you said, Veronica. In this climate, though, that's not happening. 2-3 years ago, it was happening. I even had an investor that was happy to spend 3 on one property. And boy, oh boy, did I get him a great property. It was awesome. And he had the cash flows to sustain that. But in this environment with lending rates above 6%, I'm not seeing investors shelling out this kind of cash. They're really comfortable capping it about that 1.2 mark.
I will say that's typically the type of investor we do get in Sydney is actually looking about 2.5 up to 3.5. It's like
it's just different, isn't it?
It is different.
It's different.
It's because they know that's if they decide to invest in Sydney, it's like for whatever reason the rest of their portfolio allows that is a sensible thing for them. But it's certainly, a lot of people wouldn't want to chuck all their eggs in that one basket. That's for sure.
Too true. So Brisbane, this is a really interesting one. It's almost a tale of two markets. In that mid 1 to mid 2 range, you can get a really good family home. So 4-bed, 2-bath, maybe a reproduction Queenslander, 2 living areas, double lock-up garage on a 405 square metre block. So Brisbane was largely subdivided in very similar sized blocks. 405 generally has a 10-metre frontage, 40-metre depth, and they're a very low maintenance. Still has a little yard, can put a pool in there. You can get a really nice quality property in the high ones to $2 million that you can move in and just enjoy in a family-friendly suburb, A-grade location, north-facing rear. Or you can go onto a bigger block of land and have less house. So this is where we talk about the 3 Ps, position, property, price. This is where people are really starting to make trade-off or discuss trade-offs between the house that is really livable and nice and well done on a smaller lot, or in the same location, a renovator on a slightly larger block of land, but it needs a lot of work. Livable, but probably only 3-bed, 1-bath in the same location. So this is where people have the opportunity to say, well, am I going to land bank and do something with this? And can I wait until trades are ready? And can I stomach the price of renovations now? Or do I really want to that smaller block of land and I'm straight into it? So places like Cooperoo, which is only a few kilometres south of the CBD, you can pick up a 4-bed, 2-bath, 2-car on 405 square metres, move in ready, very nice, walk to the cafes and so forth for high ones. Similar on the north side in Ashgrove, which happens to be where I live, similar type property for the same kind of money, about 5 kilometres from the CBD. But you would pay 1.8, 1.86 was a recent sale on just under 700 square metres. So bigger block of land, comparable location, but it was a 3-bed, 1-bath that hadn't been touched since the 1960s. But a character Queenslander would renovate up to a $3.5 million property if you put $1 million into it. So has that potential, but not move-in ready. So it's a really interesting price range because you can either get done, but small block, or not done, needs a lot of work, but you can turn it into something that is, takes you to the next level in terms of the house and the value of the house.
Amazing.
All right, so we're just going to quickly run through rental market, bit of legislative reform, because, if you're looking to invest in any of these cities, you need to be aware of what's on the horizon, and land tax. Very quickly, rental market in Sydney. Now, we are in the middle of winter recording this, so this is a 2024 report, if you want to call it that.
Mm-hmm.
And what we're seeing, though, the frenzy has definitely slowed over winter, and that's not unusual. There is a seasonality to the rental market. And certainly as you get, you don't want your lease expiring over Christmas, definitely not. And typically winter months in Sydney have been a bit slower in terms of people wanting to get out there and move house. But that said, there's still, so there's a lot more available for rent, but there's still a lot more people for each property than is a balanced market in the rental market. So the rental growth has slowed. It's a little bit less frenzied. Sometimes an overpriced property will not rent straight away. It will still needs to have the right rental, what's being advertised. And so that's what we're finding at the moment. Over you, Cate?
Our rental market has rebounded like nobody could have imagined, but we came off the lowest base during COVID. you couldn't give them away, and our
Mhm.
city was a ghost town,
Mm.
and we had a huge drop in rental values for quite a while. And then when we bounced back, we really bounced back. And units initially were the ones that bounced back big time because people did return to the city. And we've always had a vibrant city. We had an oversupply issue, which was, putting a ceiling on what investors could expect. And then all of a sudden, our construction woes kicked into gear, and we didn't have new construction. And we saw, if you looked at the data, days on market for sales were quite extensive. They really stretched out. And then when you looked at old listings, which is defined as 180 days old plus, that quickly got eroded. And what that said was people were just coming in and buying up all of these things that have been floating around for a long time. Some of them might have been undesirable. All of a sudden they were desirable. And that was when people were returning to the city and getting their city pad. And first home buyers were getting back into buying as well. And of course that pulled it out of the rental pool because they're selling to second home people and to first home buyers. And so all of a sudden our rental pressure on the apartment market went through the roof, and they soared. And at one stage, I think Melbourne peaked at 18% year-on-year growth, which is pretty harsh. And then houses mirrored that about 6 to 12 months later. The housing values for rents climbed and peaked as well. And people are saying, oh, rents have come off. They haven't come off at all. The rate of growth has slowed down.
Yeah.
We're still not far off 10% year on year for houses and units, which is pretty nasty. And you can pick an open for inspection, whether it's a rental or a sales, because the rental line is much longer and it sometimes stretches around the corner, especially in the trendy inner areas. It is brutal. And we've been getting phone calls and emails from people just reaching out for a little bit of a helping hand, saying, can you put in a good word? Or do you have a rent roll? Can you help me out? And that's real desperation. It's pretty awful. So while we've got this, really aggressive demand, we've had a lot of investors opting out of our market because of legislation, which is the next point, and I won't touch too much on that. And it's all been amplified. The stress has been amplified by interest rates where they're at. So if investors were thinking they were getting annoyed with legislative changes and the land tax, the hardest part is actually the cash flow.
Yeah.
Yeah, so true. And that, that's certainly across the board. And in Brisbane, look, I can say from our rent roll, so the properties that we manage as a company have gone down by 30% since COVID. So the amount of investors who have sold their properties at 30% of the properties. Now, that's not unusual. Talking to other principals of property management companies, they have seen similar numbers, and almost all of those properties have been sold to owner-occupiers. So that's a big part of where this pressure is coming from, is when an investor chooses to sell, and that's not bought by another investor, that's not even increasing the stock of properties available to rent, that's decreasing it. So we're not seeing a huge amount of investor activity adding to the investor pool. We're seeing it come out of the investor pool.
There are some arguments, and I think we should acknowledge this, even though we may not necessarily agree with it. There's some arguments that say, oh, well, if an investor sells to an owner occupier, that's okay because that owner occupier was renting, and so that's one less tenant. But I think we just need to flag that that's not necessarily always the case, is it?
No,
it's
not
not.
everybody can buy.
And also, if we think about what's happened since COVID, we've seen household formation rates dropped. We saw a lot of divorces, especially down here. And so all of a sudden you need more houses organically because you've got separations. And if we think about first home buyers purchasing property, they could have been house sharing, and they're driven out of those arrangements now because of our rental reforms. These old affordable rentals don't really exist. Student housing, it's not what it used to be. We used to just wear a blanket because the heater didn't work. Well, landlords don't get away with that now. And of course, that cost is rolled out because it's a better quality property because everything works and it's compliant. Well, you're not going to get it for $50 a week.
And that's the thing. And then this is something that, we can sort of a bit of a segue here, but when you increase the costs to landlords, there is a knock-on effect to tenants, and this is something that often the do-gooders forget. And rightly so. Everyone has a right to a secure and, I think, warm roof over their head. But there is a knock-on effect, particularly when in this country the burden has been placed on individuals to provide this rental stock. But, we've got no grounds evictions about to end. That's just been announced in New South Wales. And, to be honest, I'm not necessarily in disagreement with what they're proposing as a legislation, because there are ways in which, owners do retain a certain level of control over their property, right? So there still are reasonable grounds upon which you can terminate a tenancy. And so, for the sale of property, for argument's sake, there is one. And, or if the tenant themselves are misbehaving and breaking all the rules, then obviously that you need to be able to terminate. So I think, to be honest, we do have an issue here. But the problem is, of course, when you do restrict an owner's flexibility with what they can do with their property, there is a knock-on effect, and it does usually translate to either being some tenants, possibly the most needy ones, can no longer afford any accommodation. So it is a risk and it is a challenge, isn't it? But that's probably a bit of a side issue.
It is, and it is a greater discussion, because there's so many points in there that really need to be investigated, and that's not what we're here to do tonight. But you raised so many good points.
But I think everyone who's investing needs to be on notice that this is a changing landscape.
It is a changing landscape, yeah. So certainly in Brisbane, very tight, similar to you, Cate, lots of people around the corners lining up to go through. But what has stopped now and has been, and this is moving into the legislative sort of arena, but people used to be able to, you couldn't encourage rent bidding in Queensland. That was illegal. But if somebody chose to pay more than the advertised rent, if they chose to offer 4 months, 6 months up front, if they chose to do those things, then it was the owners, it was on the owner to accept that or not accept that. That's actually been legislated against now. So whatever the advertised price of the property is, everybody can only offer that. There's no differentiation. So I think that's a part of the landscape that property managers are really struggling with at the moment, because their job is to obviously get the maximum rent for the owner. That's part of their representation to the owner. But they also want to make sure they're attracting enough people to the property to rent it. So if you put that asking price too high and you don't attract any applicants, then you might actually completely miss the market. So it's a very tricky landscape for property managers to price that property within the legislation, but it's now not driven by the tenants as to how much they're prepared to pay for it. It's a really tricky sort of space for people to be navigating at the moment. We've also had minimum housing standards come in. I think that everything in that was pretty fair, to be honest. I think that any place should have everything that's in the Queensland minimum housing standards. It's locking windows, it's very basic things. We don't have heating as one of those requirements, Cate, but it's some very basic things and reasonable things. And end of lease, that's been in really since COVID, certain grounds upon which you can terminate a lease at the end of the lease, so at the expiry of a fixed term. And they're very similar. It's owner moving back in, family moving back in, sale of property or major renovation are the reasons that you can say to a tenant, look, we're not going to offer you another lease. But I think one of the difficult things is now rents can only be increased once every 12 months. Now, that doesn't relate to a tenancy. It actually relates to the property. So even if a tenant is in there for 3 months, breaks lease and moves out, that property, the rent can't be increased until the 12th month anniversary of the last rent increase.
Interesting.
Now, this is a vastly different landscape, and it is putting, it is meaning that when an owner puts a lease together, if that anniversary date comes during the lease, they have and they can put that rent increase during the lease, which is reasonable, because the last time they were able to increase the rent was 12 months prior. But for the tenant who goes in, yes, they're signing up for that, but that can be a bit of a surprise if it's 3 months into the lease or 6 months into the lease and they were hoping to get 12 months out. So there's a little bit of a negative knock on to the tenants because of the legislation as well.
Oh, yeah. It makes it really complicated too.
It's really complicated. Yeah.
Unintended consequences. Whoever thought the government wouldn't consider that.
Yeah. And I think that's the thing, Cate, is it's the unintended consequences that have the negative knock-on effect to the party upon which they were hoping to protect or who they were hoping to protect. And that's what we're seeing play out at the moment. And that's not I really get a bit frustrated when people say greedy landlords or whatever the case may be. There are some landlords whose rent went backwards for 5 or 6 years before
Yeah,
COVID and then
mine
went
did.
backwards during COVID that only
Yeah.
actually got back up to where they were 10 years prior after COVID. So
Mm.
Yeah.
it's not that they had astronomical growth. It's just it kind of caught up to where it was previously. And that was because there was an oversupply and like a demand.
We have to
Um,
ride the wave, like, and this is my argument as well. It's like, landlords aren't putting up prices because like interest rates go up, for argument's sake. The rents go up because the market will pay it. And that's the only
mm,
time you can put it up. And so
Mm.
legislation obviously is trying to control
mm.
prices. And as I said, this is something to be, I guess, on notice. I mean, there are other things that are in the wings in New South Wales as well in terms of legislative change, and part of that's around the rental increases and restricting it to one increase every 12 months, and et cetera, et cetera. So I think whilst the legislation is going to be different in every single state and territory, there are certainly some common threads running through
Mm.
them. The land tax is different though. Let's hit Victoria first because you
Yeah.
guys really
It's had the biggest impact.
yeah, you're down
Yeah.
to a $50,000, unimproved land value threshold now, isn't it? It's practically
Yeah,
zero.
like if you went out to a regional satellite village and bought a dog kennel, you'd still be paying land tax. Like it's a very low threshold.
Mm.
Let's talk about what this land tax increase is. They're calling it the temporary tax. It's an addition. And it will last for 10 years if it stays in place. And it's because of our cost blowout during COVID. And they've chosen to hit property investors. It's not hitting any other types of investors. So anyone who's a share investor and they're making profits, they're not being hit. So there's a degree of nasty bias to it, in my opinion, because there are more places to get land tax from than what to get
Tax.
cost blowout. Yeah, that's right. There are
Levy.
other ways to do it.
Mm.
Will
It's
they?
also sort of you're stuck with it because you already own the property. It's not a
Yeah.
choice that you've entered
That's
into that
right.
property knowing what the cost
Yeah.
was.
Yeah,
And
and
I
the
think
old
that's the thing
threshold.
that's unfair.
I do too, because a lot of people deliberately chose properties with a certain
Mm.
dutiable land value to be under that threshold. So that's probably bitten a few people that were purchasing cash flow properties and were sensitive to cash flow.
Mm.
That's a harder burden for them. But as much as I think it's a ridiculous tax, I don't think this alone should make or break an investor's commitment
No.
to buying and holding long term. However, if you're an absentee owner, if you live overseas and you're categorised absentee, it absolutely doesn't stack up. I ran the numbers for someone who reached out to me, not a past client, but someone who holds property and wanted to verify something. And I jumped onto the calculator, and his land tax bill is $110,000 per year.
Whoa.
On an individual
That's not
property,
viable.
single property.
Yeah, yeah. I
Wow.
mean, granted, it's a nice property, but that's not viable.
Mm.
No, no. It's
Mm.
and this is a thing, isn't it? That it is an interesting. Everyone needs to work out what their obligation will be before you buy a property, but it can change. I mean, this has changed and caught some people out.
Mm.
In New South Wales, we've just had a change here too. The threshold is now set in concrete. So what that means is effectively is an increase every year because the threshold previously would go up over time it was indexed, whereas now it's said, right, now it's going to be set at $1,075,000. So it's not bad threshold compared to $50,000. But, next year, if prices rise, that threshold will not rise. It will stay the
Right.
same. So over time, that means that New South Wales, people with investment properties in New South Wales that sit over that threshold, and it doesn't take a lot, depending on where your property is located, for it to exceed that threshold. Particularly if you're in the inner rings of Sydney, the land prices are very expensive. So that's something to be aware of in New South Wales as well. And typically people would diversify and buy in different states. One of the reasons the three of us are talking, because you might buy one in Queensland, one in Brisbane, one in Brisbane, one in Sydney, one in Melbourne, in order to defray those land tax obligations. And so you're not buying all in one jurisdiction. But Queensland failed in the government failed in their attempt.
We'll get to that in a minute.
Yeah. And, so what I mean is that we, like Cate said, you should not be making decisions based on land tax. You should be making decisions based on your long-term objectives and buying an asset that will grow in value in such a way that when you get that horrible land tax bill every year, as I've done many years, and looked and went, okay, what's my property worth now versus what it was, when I
The
first
cost of
bought it.
owning the asset.
Yeah.
Yeah.
And you can't even do it just for 1 year, although I have done that at times, because really you got to be thinking long term always when it comes to property. And if we are looking in short term, in short periods of time and assessing the performance of our properties, we can knee jerk, and that's not something to do, in my view.
Certainly. And you alluded to what was potentially a catastrophic legislative change that was potentially going to come in Queensland, didn't. But look, the fact in Queensland is that land tax is levied on the rateable value, or the value of the land, not the market value, but the rateable value of the land for properties that are not principal place of residence. So we're talking about properties that are investor only, not the home that you live in. That is exempt. For individuals, so if you buy an investment property in your own name, the concession is up to $600,000. So a lot of properties will fit into that category in Queensland. But if you're buying a trust or a company or some other entity other than individual name, then it's only $350,000. And many of the high quality properties are going to fit into that category. So the rateable value of the land is going to be more than the threshold. So land tax then will apply. Veronica, you talked about people often diversify and spread their risk by buying in different states. What the Queensland government proposed to do was to force the other states to reveal related entities that owned properties in different states, and then tax the individual who was associated with that related entity on the entire value of their Australian portfolio in Queensland, so at Queensland rates.
Yep. That was a quick sale decision that we made.
The amount of people that rang me and said, Meighan, I'm selling, I'm out, I'm done, I cannot, this is, it's just, so luckily the REIQ were instrumental in lobbying against that, and sense prevailed, let's call it sense at the time, but it didn't come in. But what land tax does I think for people is it is cost of holding the property. There's no doubt about it. But when a tax changes after you've purchased a property, that I think, Cate, for Victoria, that's been such a difficult thing to watch from afar and say, well, these people didn't make these decisions, these big long-term decisions with that in play. It's sort of been forced upon them, and this tax is a very difficult thing to calculate and live with every year. And it's the value. So in Queensland, it's the value of the land on a date, 30th of June in the year. If you dispose of that property and the settlement is the 29th of June, you don't get a land tax bill for that year. If you dispose of it on the 1st of July, you pay the full land tax for that year. So it's something to be really, really aware of when you're thinking about disposal as well.
We're the same on the 31st of December. So and it's not prorated. Exactly right. It's the same deal. That's our cutoff date.
When it is on, if you own it on that date, regardless of when your sale date is or disposal date. Yeah.
All right. So we've just covered off some differences, not a lot of similarities actually, but mostly differences across those three major cities. Do we want to have a super quick wrap up in terms of what do you think, risks, key drivers, opportunities, 2 sentences? What do you reckon, Cate? Can you do it?
Yep, sure can. Risk, I don't think there's much more risk. Like, they've exposed all of the risk, really. They've gone pretty hard. And I'm not being smart. I think Melbourne's had a really tough run. Victoria's had a tough run. Key drivers, we've spent so much on infrastructure. I mean, that's partially why we're in a bit of a mess right now. We've got a bit of a deficit problem, but we've got some pretty cool things happening around our city. We do remain a favoured port for new arrivals. And we've got some big employers down here. We've got healthcare employers. So there's a lot going on that will continue to attract a crowd. And I think when things settle down and people get their heads around everything, we'll see Victorians staying put a little more than they have been. Let's talk about the opportunity, though. The value proposition is enormous. And I've helped so many Sydney-siders who have moved down here to work or have decided to invest. And it's not just Sydney-siders, but it's mostly 90% of our activity with investors East Sydney siders. And I think also the opportunities once our market picks up and people can, at the moment we've got investors saying, well, I'm dealing with this land tax bill and I haven't had any price growth on my asset. What's the point? When we see some price growth, that will be aided from a number of things, but it will most likely be an economic recovery for Victoria, but also inflation woes calming down and interest rates either reducing or settling, and less panic around economic conditions. So in short, I think there's upside. The question is, when will we see those opportunities?
Yeah, which makes it, everyone says, I wish I'd bought at the bottom of the market. God, it sounds
Come on,
like
we're
that for
right.
Melbourne.
And we're staying put as well. It's not like it's, it's bottomed and it's
It's almost
bounced.
like it's yelling, here I am at the bottom.
But they don't want to, because they want to wait. They want to wait in case it drops
wait
further.
to see the green shoots of recovery. But I think you're right, Cate, and it's sort of been sitting in the back of my mind for some time. And I'll never, recommend anything outside my area of expertise, which is why we always say, talk to you about what's happening in Melbourne. But it just seems like it has been quite flattened at the bottom for a while. So yeah, I'd second that for opportunity.
How about you? What do you reckon in Brisbane? What are your market risks, Meighan?
I think the risk at the moment is we have been in FOMO. Buyers have been in FOMO for so long that they are prepared to compromise on the wrong things. And a poor asset is a poor asset, regardless of what you pay for it and what the market is doing. So the risks are that people rush into a purchase without doing their due diligence thoroughly, that they don't understand the right due diligence that they need to do, because there's so little seller disclosure in Queensland. It is really up to the buyer to know what to do, how to do it, and how to interpret it. So I think the risk is that in the fear of missing out completely or being priced out completely, that people make poor decisions, and those poor decisions in the long run will have a bigger impact on them than if they'd been a little bit more careful and cautious and bought a good asset. I think the opportunities sit in those renovators, the properties that you really have to kind of live with for a while until you can pull together enough money to turn them into something grander, almost a stepping stone within the one property, as opposed to stepping stone between properties. Because it's the same thing that I've done myself. I've done buy it, renovate it, use the equity, or sell it and go to the next property. They're the properties that are being not largely avoided, but there are opportunities there, I think, if you're prepared to wait it out and do the renovation on them and put, a fair bit of money into a good property to do that in a good location. The rental market for investors, I think it is about being very discerning about what you buy and where you buy, and not being too sensitive to price point. And what I mean by that is, if you say, well, I'll spend $1.2 million on that property, and you've set that limit yourself, but a better property in a better location is there for 1.3, and it adds up, then taking that self-imposed limit away might get you an even better property, far in excess of what you would get if you sat on that. I want to stay under $1 million, particularly that price range, is a little bit more riskier. So I think good opportunities, that we've still got the Olympics to come. So there's a great deal. I would probably say that's a bit of a risk too, is putting too much emphasis on where are the Olympics going to be, where are they going to be held, and where's the money going to get invested, because Brisbane's really not that big. You can get anywhere in about 20 or 30 minutes. So if you focus on quality asset, where the Olympic venues are, I don't think that's going to have as big an effect as it might have in the past.
Only 2 weeks of it, anyway. I mean, I just remember back to 2000, the Sydney Olympics. So if we look at market risks in Sydney, well, I mean, Sydney obviously being the most expensive city, the market risk is cash flow, really, in many ways. It's like you've got to be able to fund it and sustain it. And what if interest rates go up, et cetera, et cetera. And also Sydney yields, or rental yields, have typically been the lowest in the country as well, as a consequence, in a way. Rents are much more constrained, I guess, by incomes than price growth, because there's other aspects or elements that go into property prices. So I guess that is a risk in terms of anybody investing in Sydney has to be able to basically stump up some of the costs for, quite a few years. And it might be 10 years before you even get into neutral gearing territory. So therefore, you've got to be able to support that, and you've got to have commitment and conviction in the asset that you choose, and that it's going to do the job for you capital growth wise. And even though Sydney market at the moment, as I mentioned, is a normal market, which is quite stable, we have had volatility in recent years. And so when it goes up, it really roars. And when it falls, it'd be pretty horrible too, right? On the other side of that. So, and I think if you look at the long-term trend, it's up, right? But you've got to choose individual asset. There's no point looking at the whole market as a whole, because I've known people have lost money in rising markets because they've chosen a poor asset. So it's very important, like in all, and that, I guess that risk applies in all three locations. The key drivers, very similar to in Melbourne, really. It really comes into, Sydney has a much more favourable climate than Melbourne. People want to come here for the beautiful
Oh, don't
harbour.
take me on climate, Veronica.
Yeah, I don't like humidity. But the point being that Sydney is a very desirable city for lots of reasons, for lifestyle reasons, and there's always going to be a desire for people who want to live here in good suburbs, in good locations around this city. So that's going to be a constant. That's not going to change. And equally, a lot of immigrants come here first. That's their first port of call. So in terms of the rental market in particular, that's quite a driver. So you've got sort of all of that going on. You've got, high income earners living here. You've got high income, high paying jobs. And the opportunity, I think, to be honest, I know it sounds a bit ridiculous, the opportunity is to buy an inner ring house, an A-grade house, for less than $2 million. And because I reckon that little door's going to shut soon, and we'll be in the over $2 million for a house. And then you're really only going to be looking at apartments. So if that's your budget and you've been thinking around buying an investment property and you're wanting to get a house in Sydney, honestly, I think that is the door that's only ajar at this minute.
Interesting.
Very interesting, isn't it? And somewhat alarming. When you think about it's $2 million for an entry level inner ring house.
Crazy.
In a capital city.
Crazy,
This has been absolutely fascinating. I've learned a lot.
Me too.
I hope that those that have tuned in have learned a lot. Remember, we recorded this at the end of July 2024. So this is relevant in this period of time. It could have changed by next week, and I kid you not.
All right. So if you want to reach out to any of us, there's Cate
at catebakos.com.au.
Kate at catebakos.com.au. Is Meighan.
Let's go with hello at propertypursuit.com.au. It's much easier than trying to spell my name.
Okay. V Morgan at gooddeeds.com.au. But look, we'll put the links below wherever. We don't even know where we're posting this yet, do we, ladies? But we will put it somewhere.
Everywhere.
We'll make it really easy for you to contact us if you want to ask us any questions about buying investments or homes to live in our necks of the woods. Thanks for tuning in. If you stuck with us this long, then we really appreciate your eyeballs.